Good morning and welcome to this Wednesday, November 3rd, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're now heading into our third day of November, which historically is a very, very solid month for equities. We've seen the market rising. Mostly the past couple of days, really the last week or so. And this morning we got a little mixed picture. We got Dow futures down 77, S&P down 6, but the NASDAQ is up 17. That was as of probably about maybe 10 minutes ago. And we've got the ADP employment report out this morning. So jobs came in a little bit stronger than expected. Of course, the big report is the non-farm payrolls report on Friday. So we'll get a little bit better idea when that rolls around. But in the meantime, the market seems to be in a pretty good place. We've got all-time highs that are being set really across the board. But we've got the S&P 400 mid-cap index, which has recently broken out to join the other larger cap indexes like the Dow Jones and the S&P NASDAQ 100. And so, I think the market is setting up here for another rally. I mean, short term, we could see profit taking pullback anytime. But as I mentioned, November does tend to be a very strong month for U.S. equities. So we'll see what happens. Let me take you over to Earnings Beats. 1 second. All right. So for those of you who are new to Earnings Beats, if you go over to our website, earningsbeats.com, you can scroll down and you'll see this area where you can subscribe to our free newsletter. It's our Earnings Beats Digest newsletter, published 3 times a week, Mondays, Wednesdays, Fridays. Very quick read, usually out around 8:30 or so in the morning, a little bit before the market opens. But usually it's a couple paragraphs. It's also, there's normally a chart that just highlights something that we find, really important. I talked this morning in the newsletter about, and I'm going to talk about this more during the show. It doesn't happen often, but when it happens, you've got to be ready. And I am seeing more and more strength in these heavily shorted stocks. Our short squeeze chart list is really starting to roll. Most of the time you want to stay away from these stocks because they are heavily shorted, many of them downtrending. But when they start to turn and they start to show positive momentum and they begin to break out, it puts a lot of shorts in an uncomfortable position of having to either accept the fact that they've got unlimited risk to the upside and they could be in the midst of a short squeeze, or they're going to have to cover. They've got to buy the stock to end the pain. So they really don't have a whole lot of choice. And as the volume starts to pick up and these stocks start to move up, it's like screaming fire in a movie theater. You got the one exit down at the bottom, everybody trying to stampede out at one time. And that can get kind of crazy. And that's what happens with these short squeezes. So we're going to talk a little bit about that in just a minute. But a couple of reasons that, you might think about subscribing to our newsletter. Number one, it's free, no credit card required. You can unsubscribe at any time. So that makes it pretty simple. But we also provide during earnings season free upcoming earnings chart lists. So we give you all the stocks in one chart list that reported yesterday after the close and today before the open. So all the stocks that reported since yesterday's close are on one chart list that you can download into your stock charts account if you have it. If you don't have a stock charts account, you can still view the charts. So you'll know which ones are coming up. You'll be able to take a look at their charts and all. But I think that's a really cool feature. One of the guys that works for me, Matt Townsend, he puts this together for you all each week. And I think it's a great way to keep track of earnings announcements. Like first thing this morning at 9:30, 9:40, first thing I'm going to do is I'm going to pull up that upcoming earnings chart list. for today to see the big reactions in both directions, both up and down. So it's a great, you want to have this Earnings Beats Digest because you'll have access to these chart lists. It's a free, gift that we give basically to anybody who's in our community. And the final reason that you want to be in this is that when we have free events, like tonight, we're having one. It's a sneak preview of our earnings reaction portfolio, which has been performing pretty well. Didn't have a very good day yesterday, but has been performing pretty well. And we're going to talk about how we construct that. And then next week, we're going to actually have a draft where we put 10 stocks in there that have shown great earnings reactions. But I'll talk more about that at the event later today. But that's a free event. If you're a Earnings Beats Digest subscriber, you'll get the room link. So if you haven't already, make sure you go in, type in your name, email address, and get that started. All right. Let me go over here, take a look at what happened, excuse me, on Tuesday. We had the Dow Jones Industrial Average close over 36,000 for the first time in its history, closing up 139 points. Let me say that again, first time in history over 36,000. A lot of folks, we were pulling back a couple months ago, once again, wanted to write off this market. I said, chances are we're breaking out again in the fourth quarter. Well, it didn't take long. Here we are, November 3rd. Not only have we broken out, but now we're setting a new milestone over 36,000. The S&P 500 just recently broke over 4,600 for the first time in history, and it just keeps tacking on, added another 17 points yesterday, getting closer and closer to my target on the S&P 500 at the end of this year. Back in our event that we had the beginning of January, I made a prediction. The S&P 500 was about 3750 at that time. I said I thought it was going to 4750. Well, we're at 4630 now. Not too much further to go to get there. I'll have an interesting prediction for 2022, by the way. Just a little, just whet your appetite there. Anyhow, NASDAQ yesterday up 53 points, closing at 15,649, a new all-time high. Mid caps, there you go, 2857, closing up 5 points, another all-time closing high there. Small caps on the verge. I think it's 1,415 that we have to close above. We're at 1,407 and change. So there's just one little small missing ingredient. No pun intended, small. But the small caps, we need to get through 1415, and then you've got all the major indices at all-time highs. I mean, get bearish if you want, but all-time highs, it's hard for me to be bearish. Materials leading the action on Tuesday, up about 1%, trying to get back through this key area around 86.25. That's right about where we finished. If we can get through that, then I think we make a run for that late May, early June high that we saw. But we still got a little work to do there. Real estate, putting in the right side of this cup, finishing yesterday at 48.38. That was up about 1%. So I think we got a nice little cup, maybe a little handle forming. I think eventually we break out. I'm not a fan of real estate because on a relative basis, I don't think that's where you want to be. I think you want to be in technology, which is already broken out to another all-time high. I think you want to be in consumer discretionary, which took the day off yesterday. Communication services, financials, industrials. Industrials love the month of November, and I'm just waiting for the breakout on the XLY. Those are the areas I would be focusing on. But that doesn't mean these other groups won't go higher. In a bull market, secular bull market advance, just about everything goes up. I'm talking about on a relative basis, not on an absolute basis. Staples also had a nice day, up about 2/3%, back up almost to 72. You can see we got up to almost 73 back in August and September. So we still got a little bit more work to do there, but we are at least trending above the 20-day, which, by the way, just crossed its 50-day. So you got a golden cross there on consumer staples, just coming along for the ride. And then energy continues to perform well. And I don't know if any of you have been to the gas pump recently. I'm sure you probably have. A little sticker shock there. I got gas here in South Carolina the other day for $3.19. And I know other parts of the country are a lot higher, but I can't remember the last time I got gas for $3.19. Now, part of it could be my old age and lack of memory, but it's been a while. I can tell you that $3.19 pretty high. Anyway, energy benefiting from the rise in crude oil prices, and OPEC's resiliency or not resiliency, but OPEC's, what's the word I'm looking for? Not inability. They're just being a little stubborn in terms of increasing production. So if you're not going to increase production, you're going to see, and demand keeps going up. It's economics 101. You're going to see prices rise. You're going to see the energy stocks do well. Once again, yes, energy doing well, but not the group that I'm going to be focused on as we go forward. And I might be wrong. I've been wrong for 2021. Energy's been a leader. And I, for the most part, have stayed away from it. I've traded maybe a couple of stocks here and there, but that has not been my focus. So can't get them all right, that's for sure. But energy continues to do well. Anyhow, that's a look at what we saw on Tuesday in terms of the major indices and the leading sectors. If we take a look at the 10-year Treasury yield, let's get a quick update. Economic news, as I mentioned, October ADP employment report was out this morning. The expectation was for 400,000 jobs. We came in at 571,000. So a little bit better than expected there. Later this morning, we have the October PMI composite out. The expectation there is for 57.3. Then September factory orders will be out. August rose 1.2%. September is only expected to rise 0.1 of 1%. So we're expecting factory orders to slow down, but keep in mind that this is kind of in the rear view mirror. I mean, we're talking about September factory orders. It's November now. So the factory orders and a lot of the housing reports are dated. So I tend not to look at what's going on there. I'd rather look at what's going on in the industrials. The fact that September factory orders are only expected to go up 0.1 of 1%, that's already been priced in. That's one of the reasons why industrials haven't done well on a relative basis. But industrials, if they break out and they start to show relative strength, then I think we can assume that we're going to see those factory orders picking up in the future. Again, I try not to pay too much. I shouldn't say that. I pay attention to the fundamental information, but the charts, the technicals, they're always looking forward. And that's the key. That's why I follow technical analysis, because a lot of times the technicals have already taken into account everything that we're seeing in the fundamentals. We see it a lot with earnings reports. Companies come out with blowout earnings reports, but they've already gone up 40% in the last month. So the earnings are priced in. And then who knows what kind of reaction you're going to get. Anyway, I digress. October ISM Services Index expected to remain unchanged from September at 61.9. And then at 2 o'clock today, we have the FOMC policy statement due out. What's the Fed got to say? What's their time frame? Are they going to do anything different as far as raising rates? Some are saying, hey, you need to start raising rates now. They're being pretty patient. What about the tapering? What are they going to have to say about the tapering? All that's going to factor in to what happens to the bond market after 2 p.m. today and the stock market. Get a lot of knee-jerk reactions to the stock market. You know, I wrote an article last month, I think, before the Fed announcement, and it was talking about looking back at the history of market reactions to the Fed announcement. For the most part, we don't really see much a week after the actual announcement. So while we think there's and there is a lot of volatility, at the end of the day, there really isn't a whole lot a week later from where we are. So I think a lot of it's just more hype and headline news, trying to shock everyone than it is much of anything else. I mean, I think the Fed is pretty transparent about what they're going to do. So unless they come out with some shocking revelation, then I wouldn't believe that there's going to be too much of an impact. Anyway, that's the 10-year Treasury yield. We are down just slightly today, about 1 basis point, 1.54%. I still think, to the downside. I mean, we could go all the way to this breakout down just below 140. I think we'll probably hold on to that 50-day moving average, which right now is coinciding with this support area around 146, 147. So that's probably about as far as I believe we're going to go down on the 10-year Treasury yield. If we do go lower, then it's telling us, hey, forget about inflation. I think it's already telling us that. But if it were to break back down below 146, those in the camp of inflation, I don't know what to tell you. But the bond market's a pretty smart group. And if there was an inflation problem out there, folks would be selling bonds like crazy. No reason to hold a bond yielding 1.5% if you believe inflation is going to take off. You want to continue to collect that 1.54% for the next 10 years while inflation runs crazy? What's that going to do for you? You would see yields would be absolutely exploding to the upside. You got to pay attention to what the bond market's saying. You know, it's not me. I don't know what inflation's going to be. I just will follow the charts. The charts are telling me inflation's not going to be a problem. All right, moving on. Let's, I've talked about this once before, but I'm going to bring it up again. I talked about it yesterday on the show, but this is a kind of a big deal. The mid caps. You can see sideways action for months. And finally, we broke out the week of, well, it looks like maybe right around the end of that week, the 18th to the 22nd of October. So right in the middle of October, made the breakout. We pulled back through the 27th, which historically is the date that we have to be a little careful of, you know, that week. So we did see a little bit of weakness to take us back down to about where the week started. But since then, we're in the most bullish period of the year historically, dating back to 1950 on the S&P 500. And you can see the last 4 days now, the mid caps have done well. My work has been centered on the S&P 500 on the NASDAQ. But mid caps following suit, you know, the 28th through November 5th, November 6th, that time frame, very, very bullish. And we're seeing it again this year as we rise. So I wanted to point that out. And then I mentioned earlier the industrials, waiting for this breakout. This is what I'm talking about. Let me annotate this for you. So we've got all of these tops up here, no open or close above the top that we saw in June. That was the open here. But that's somewhere in the neighborhood of about 105.50. I'll give you the exact number in a minute. 105.50. Yesterday we were as high as 105.22. I mean, we're right there. And then the low that was established back in September. I mean, at this point, I would say this is the range, 98 to 105.50. Now, we're in November, and before you say, well, you know, sell here, ordinarily I would say, yeah. But one thing I'll caution you about is that if we look at the seasonality, and this is really for the benefit of those of you who are maybe new to the show, because I've talked about this a lot in the past few weeks. But if you look back over the last 20 years on the XLI, 18 out of 20 have risen, have gone up. 18 out of 20. Look at that. I mean, it's standing way above any of the other months. The average return on the XLI for the last 20 years during the month of November, 3.5%. April 2nd at 2.6%. And third is July at 1.3%. 3.5%. That's a huge level of outperformance. One last thing I'll show you here. XLI versus the S&P 500. If we just go back during, I mean, I'm just dragging this back 1 year at a time. So we started 5 years, 100%, 6 years, 100%. This is how many times the XLI has outperformed the S&P 500 in the month of November. That's 7 years in a row, 8 years, 9 years, 10 years, 11 years, 12 years, 13 years, 13 years in a row. Industrials have outperformed the S&P 500 in the month of November by an average of 2 percentage points, by the way. And then you go to 14, 15, you can see it starts to drop off a little bit, but still 17, 18, 19, 20, it's, 20, 90%. Not only have we gone up 90% of the last 20 years during the month of November, but the industrials have outperformed 90% of Novembers. Basically this century. So do you want to sell the XLI as it's nearing resistance? I mean, normally short-term trading, I would normally say any chart I'm looking at, when I'm up against resistance, I'm probably going to sell because I can buy it right back if it gets through. Look at all these times we go up here. We set the high. We go up. What if we said, oh, I'm going to hold? I think it's going to go through. Look at what happens 10, 15 days later. Then it comes back up here again. Oh, it's going through this time. 5 days later, right back down. Now, oh, this is the time. Right back down. Then you come back up here just last week. Of course, it was during the bearish period of the market still. But hey, here we go. Nope, pullback. But this time is a little different because we're holding that rising 20-day. Each of these prior times, we went right back through the 20. This one, we held the 20. Now we're right back up here again. So, and knowing the history, it's hard to bet against the industrials right here. So when you look at the, key, one of the keys in the industrials is the transports. Don't know if you're paying attention, but transports breakout. How about the IYT? IYT challenging that breakout. This is the iShares of the transportation average and ETF. So, I mean, if we get the IYT breaking out, in addition to the transport already breaking out, transports breaking out, then we've got a very key component of industrials screaming at us that it's going higher. So that's why I believe the XLI is going up and going to break out. I keep continuing to point out to members to really watch this, because if we get the breakout, there are stocks seasonally that do very well. And the seasonality report, which is still coming, I promise, to all of our Earnings Beats members. I've just got a lot of things I'm trying to get out right now. But I did send everyone the 20 stocks for November that are on our seasonality list. And that list has been updated on our website, by the way. So you can go in and download the November seasonality chart list into your account if you have one at Stock Charts. If you don't, you can go and view it. So you can take a look at the various stocks on the list. But we do this so that, hey, if transports break out or if industrials break out, look on the list and see if there are industrial companies that are on that list. And if so, they may be poised for a rally just based on nothing more than history and, of course, the technical breakout in the group. All right, let's keep moving on. I want to go through, I want to talk a little bit about these stocks that are being heavily shorted. For those of you who don't know, we keep a short squeeze chart list for our members. We update it twice a month. And it lists the companies that have short percentages of float above 20%. So in other words, not only, you got buyers and sellers of the float. The float is the number of shares available to trade. That's what the float is. So when you've got short percentage of float that's above 20%, what that means, let's say a company's got 100 million shares available to trade, unrestricted, 100 million shares. If a company's got 20 million or 20 percentage points of, or if they've got a short percentage of float of 20%, that means of those 100 million shares, somebody's gone to their broker and borrowed, well, everyone collectively have gone to their brokers and borrowed 20 million of those 100 million to sell. So you've actually had 120% of the shares sold. At some point, those who borrowed those shares have to buy them back and return them to the broker that they borrowed them from. The analogy I like to use is, let's say, your next door neighbor's got an old Bentley, and for whatever reason, you believe the Bentleys are about to lose value. And it's just been sitting over in his driveway. He's not using it right now. It's just sitting there, just like a stock sits at a broker, not being sold. It's just sitting there. So you go to your neighbor and you're like, can I borrow? You mind if I borrow your Bentley for, just for a period of time? And of course, your neighbor, being the generous soul that he or she is, says, sure, here are the keys. So you take that Bentley and you go, and right now, let's say it's worth, I don't know, 100 grand. And you go take it somewhere and you say, I'm going to sell this Bentley for 100 grand because I believe it's going to go down to 90 grand. And then when it does, I'm going to buy it for 90 grand. And then I'm just going to take it back to my neighbor. Here's your Bentley back. And in the meantime, what did I do? I sold it for 100,000. I bought it for 90,000. So I just made 10 grand. That's what short sellers do. They borrow everyone else's shares, but they have to buy them back. And so when you get a short squeeze take place, and I'll show you one that I mentioned to members. It was actually, this is the one I had in the Earnings Beats Digest report this morning. This company has more than 27% of its float short. Now, what do you think? Anybody who has shorted this stock in the last 6 months, imagine the predicament they're in right now. So let's say you borrowed someone's shares and you sold it for $7 or $8. Let's say, you borrowed 1,000 shares. and you sold them for 7 or 8. Just in the past 5 days, you've seen that in that borrowing and that your obligation, which was down at $8 or $9 just a week ago. Now your obligation, in order to buy those shares back, it's going to cost you $15,000. Don't you think that's going to start to make you a little nervous? I mean, if you sold it for $8,000 and now you owe $15,000, what if it gaps up to 18, or what if it trades today and gets up to 17, 18, 20? I mean, when these stocks start going, it's not rational. It's irrational. It has nothing to do with fundamentals. Look back at GME, GameStop. This stock went, and I wrote about this, by the way, in the Earnings Beats Digest newsletter in September, way back here, when it was trading at about $6. I said, this could be the mother of all short squeezes. Look at what happened to GME when it finally got going. I mean, honestly, I thought this was a short squeeze. That was nothing. Now, GME had over 140% of its float short. I've never seen anything like that before in my life. We probably never will again. The SEC probably won't ever allow it. I mean, now you get to the point where a stock's heavily shorted, and you try to short it, and you can't even get shares. And I think, brokers are starting to take notice of what's going on. But anyway, GME made that huge run. Should GME have been a $500 stock? No. And in fact, 3 weeks later, it was a $40 stock. And then right back up again. Probably those shorting on the way back down got caught in this one going back up. But you can see now, a year later, it's never gone back up to that level. It was irrational. Borrowing Alan Greenspan was the one that said irrational exuberance. Well, that's literally a short squeeze stock is a poster child for that. This is what can happen. Now, that's an extreme, but I mean, there are other stocks. We could pull up something like Virgin Galactic. Look at the move. Look at the volume pickup. Look at this move. Look at the volume. Massive volume. Here at the peak, 250 million shares. Yesterday, the stock traded 7.9 million shares. So when it gets going, the volume goes crazy because you've got all these shorts tripping over each other, trying to buy to get out of these stocks. And that's what creates this demand, this insatiable demand that drives these prices higher. So getting back to that OCGN, this is one of our 45 stocks on our short squeeze chart list that has been starting to make a move. Now, this one is one of the more pronounced moves so far, but this thing's been all over the place. I wrote about this and sent it out to our members a week ago in our daily market report. Now, when I did, I said, be careful, because I said volatility is crazy. And I said at the time, this stock could be 15 in a couple days, or it could be back down below 10. I think I sent it out when it was like 11:58. Well, it went down that afternoon to 8 and change. And now a week later is over 15. It did both within a week. That's how crazy the volatility can be. So you don't want to think about putting big positions in. I personally would not. I wouldn't even think about it, because they can go in the opposite direction, go against you, and then they become very, very painful. But just a couple stats here on this chart list that we have. And if you're a member, that's even a free trial member at Earnings Beats, you can get this chart list. Yesterday, 10 of these 45 stocks on our short squeeze chart list gained more than 4%. Over the last week, 15 of these 45 stocks have gained more than 10%. 26 of the 45 gained more than 5%. And 34 of the 45 beat the S&P 500 last week. These are very unusual numbers. Short stocks that are heavily shorted are normally heavily shorted for a reason, and they tend to trend lower. Now we have 8 of the 45 stocks on this chart list that have Scooter's stock charts technical rank, which is a relative strength score, above 90. 8 of them are above 90 now. So the key here is you don't get short squeezes until you start seeing bullish momentum on the chart. So another thing that I had done recently was compare the number of stocks right now with PPOs above 0. That's just simple bullish momentum. If your PPO is below 0, it means your short-term moving average is below your long-term moving average. So it's kind of a poster child for negative momentum, selling momentum, bearish momentum, whatever you want to call it. When your PPO is above zero, and I know it's 9:30, I'm going to run a little bit late on this one, but I think this is pretty important. This is kind of a big deal with these short squeeze stocks when they get going. But right now, we have 25 of our 45 stocks on this chart list with PPOs greater than zero, more than half. The last time that happened was at the end of December of last year. And do you remember the short squeezes in January after that? Once these stocks start to show a little bit of momentum, I'm not saying that this is absolutely going to happen. What I am saying is that the conditions are ripe. Think about a tornado. You know how the meteorologists always say that, the conditions are ripe for a tornado. This particular area has a 30% chance of a tornado somewhere in this area. That's kind of how I would use, that's the analogy I would use to describe short squeeze chart list. When you start seeing these momentums, it's like, okay, we know some storms are coming. We don't know for sure that they're going to hit, but we know the odds are building. That's the way I would approach this. Anyway, there weren't a whole lot of big earnings reports out, so I'm not going to spend a lot of time there. Amgen reported better than expected earnings last night. Paycom beat 92 cents. Remember, I talked about stocks that make these big earnings runs. Look at this move up. Look at Paycom today, down $43 after beating earnings expectations. Now, I haven't seen revenues. I didn't see revenues. I didn't see any guidance, but they beat by a penny. And stock market says, okay, well, we've run up. We've already priced a lot of this in. And so the stock getting hit. I know Solar Edge was another one that was seeing similar action. Stock down 7%, $27. So a lot of big hits to the downside. Got to be careful with these stocks that make big runs heading into earnings. Even if they beat, even if they come out with good numbers, you just don't know what the reaction is going to be. All right, we're going to go ahead and pass on the three you must see today. I didn't have any ready for you, and I know it's after 9:30 anyway. Let me just take a quick look at the market for you. And currently, you can see that we have Dow down 72, S&P down 4, NASDAQ down 3. So we got a little bit of negative action, not really much. Small caps down just a fraction, same with the mid caps. So all in all, not too bad. Action's pretty solid. NASDAQ 100 actually showing positive action this morning. So those large cap tech names, many of those doing well. All right, that is it for me. I appreciate you all tuning in. We got, like I said, the Fed meeting coming up 2 o'clock today. I don't think there's going to be anything major. I mean, the Fed's pretty good at being transparent. So I don't know that they're going to change anything. I think you'll get an initial reaction like we always get, up and down, back and forth. But I think, probably the market's going to go where it wants to go, which in my opinion is higher. So we'll see what happens. Anyway, everybody have a great day today. I'll be back tomorrow over at Stock Charts TV, which you can access right here tomorrow morning at 9 a.m. So it'll be a recorded version, but check that out at 9 o'clock tomorrow morning. Everybody have a great day and happy trading.